Welcome back to Iron Financial. We are the Explainer channel, totally dedicated to helping you forge a stronger portfolio, cut through the daily market weakness, and find those absolute steel-plated cornerstones for your long-term investments. If you're looking for institutional-grade breakdowns of the massive companies that are literally driving the market, you're going to want to hit that subscribe button right now. Because today, we have an absolute monster of an earnings report on the anvil. We're doing a deep dive into UnitedHealth Group's Q2 2026 results. And let me tell you right out of the gate, this quarter is an absolute paradox. It's fascinating. Management just raised their full-year guidance, projecting massive, undeniable strength and profitability. But they did this despite the undeniable fact that they're actively shedding hundreds of thousands of members across the board. So the core question we have to answer today, is this unquestionable financial strength, or are we looking at hidden cracks in the armor?
That is exactly the tension we need to resolve. Look, I'm looking straight past the headline numbers today. I have to be honest with you, every single time a company comes out and raises guidance while their core customer base is actively shrinking, my alarm bells immediately go off. We have to figure this out together. Is this raised guidance a result of actual heavy lifting and fundamental business strength? Or is it just management spin? You know, the kind of slick accounting magic that hides deep structural cracks in the foundation of the largest healthcare company in the world. We are going to severely stress test these numbers today, because you, the listener, need to know if UNH is a solid, load-bearing beam for your portfolio or if it's about to buckle under the sheer weight of lost market share.
Okay, let's dive right into this and lay down the steel beams. The top-line numbers for this quarter are simply staggering to look at. For the second quarter of 2026, UnitedHealth Group reported total consolidated revenues hitting exactly $112.0 billion. Let's just pause and put that massive scale into perspective. That is up from $111.6 billion in the exact same quarter last year. And it's not just empty, low-margin revenue padding the top line either. The actual earnings from operations surged to $8.0 billion. That is a massive jump from the $5.2 billion they posted in Q2 of 2025. We are talking about a net margin of 4.9%. The sheer scale of this cash-generating machine is operating at an incredibly high temperature right now, and the foundation looks incredibly solid from where I'm sitting.
Okay, I hear those massive revenue numbers, and I completely acknowledge the titanic scale we're dealing with. But I have to interrogate this top-line strength right away. Yes, $112 billion is a massive number, but we have to ask the obvious question, where do the members actually go? UnitedHealthcare is literally serving fewer people right now than they were before. They are pulling in more money, they are generating billions more in operating earnings, yet their total medical membership has declined. As an investor looking at a business model, when I see revenue holding steady or climbing but the actual unit volume dropping, I have to ask the critical question. Is this sustainable pricing power, or are they just squeezing a shrinking base harder and harder until it finally breaks?
That is the exact tension we're going to unpack segment by segment as we go through this explainer. But first, let's look at the bottom line profitability, because this brilliantly illustrates exactly how management views their ongoing operations. The reported GAAP earnings per share came in at $6.04. However, the non-GAAP adjusted EPS, which strips out all the one-time noise and accounting friction, was $6.38.
Right, and as investors, we always need to question that specific gap. That 34-cent difference between GAAP and non-GAAP is often where the bodies are buried in these earnings reports. In this specific case, it includes intangible amortization and some very significant restructuring costs. When management points us to the $6.38 adjusted figure, they are essentially asking us to ignore the heavy lifting costs of that structural reorganization. We have to decide for ourselves if that represents true structural profitability going forward, or if it's just a highly polished surface masking a flawed foundation that is going to keep requiring incredibly expensive repairs quarter after quarter.
Well, to figure that out, we have to look directly at the engine's fuel efficiency. And in the health insurance business, that ultimate metric is the medical cost ratio, or the MCR. For anyone who might be newer to analyzing healthcare stocks, the MCR is simply the share of a health insurer's premium revenue that is strictly spent on patient care and medical claims, rather than administration or profit. Think of it exactly like a pressure gauge on a giant boiler. A high ratio means most of the money is flown straight out the door to cover care, which massively tightens up their margins. A low ratio indicates higher profitability, meaning the company's keeping more of that premium dollar for itself. Setting up this quarter, the MCR is the absolute most important metric to watch to understand their core profitability.
And here is absolutely the most striking number of the entire quarter. UNH reported an MCR of 86.7% for the quarter.
That is a massive, highly significant drop from 89.4% in the exact same quarter last year. A 270 basis point improvement in the medical cost ratio on a $112 billion revenue base is an incredible display of margin expansion. Management attributes this directly to extreme pricing discipline, strong medical cost management protocols, and very deliberate product design changes. By aggressively keeping that pressure gauge low, they are essentially forging a much more profitable book of business. This is pure heavy lifting paying off.
I'm going to push back hard on this right now. Is this real, sustainable strength? Because when you actually dig in and read the fine print in the 8K filing, that beautiful 86.7% MCR was heavily affected by $860 million in net favorable prior period reserve development. What does that actually mean for your wallet? It means they overestimated their costs in the past, hoarded cash, and now they just released those massive reserves into this quarter's earnings to make things look pretty. Without that $860 million accounting tailwind, does that MCR really look as pristine? Furthermore, their operating cost ratio actually rose to 12.7%. Management is quick to blame targeted AI and infrastructure investments, but rising operating costs paired with released historical reserves, that is a potential structural crack if those supposed AI efficiencies don't materialize very soon.
You can argue the reserve accounting all you want, but you absolutely cannot argue at the hard, cold cash hitting the bank. Let's look at the absolute powerhouse that is their operating cash flow. UNH generated $11.1 billion in cash flows from operations in this single quarter alone. That is 1.9 times their net income. When your cash flow is nearly double your net income, that is the literal definition of high-quality fortified earnings. Now, the filing does note this reflects the timing of a substantial government payment alongside their strong earnings performance, but at the end of the day, that cash is fully secured. It's in the bank, ready to be deployed.
And what they are actively doing with that cash is forging incredible balance sheet armor. Let's walk through the rivets holding this massive corporate structure together. They reduced their debt-to-capital ratio down to 41.2%, which is down from 42.9% in the first quarter. And they are actively targeting a long-term ratio of 40% by year-end. Getting debt under control in a high interest rate environment is absolutely crucial for stability. On top of paying down that debt, they have aggressively repurchased $4.0 billion of their own stock through mid-July. And they aren't stopping there either. They are targeting at least $5.0 billion in share repurchases for the full year 2026. Management simply doesn't buy back $5 billion in stock if they think their underlying business model has a structural crack. They do it when they know the foundation is made of iron.
All right, let's take the wheel here and drill down into segment number 1. This is UnitedHealthcare, the core insurance engine of the entire operation. And honestly, this is exactly where my skepticism gets really loud. Despite the massive overall corporate revenue we just talked about, core insurance revenue actually ticked down slightly. They pulled in $86.1 billion this quarter compared to $86.1 billion last year. And here's the structural crack I've been waiting to hammer on. A sequential loss of 525,000 members. Over 500,000 people are no longer being served by UnitedHealthcare compared to the prior quarter. Total medical membership is down to 48.5 million. When you are the absolute largest health insurer on the planet and you are shedding members by the 500,000, you have to stop and ask, is the foundation crumbling? Are nimble competitors eating their lunch? Or are they just pricing themselves completely out of the market?
Let's break down the exact locations of these membership leaks because it's happening all across the board. In Medicare Advantage, they are down a staggering 965,000 seniors since year-end 2025. Nearly 1 million seniors gone. In Medicaid, which is their community and state segment, they are down 380,000 people, which the company attributes to a planned exit from the Louisiana health plan and ongoing strict state eligibility requirements. And even in the commercial segment, the employer and individual business, they are down 145,000 members due to attrition in both self-funded and fully insured products. I need you to explain to me how losing massive volume across all 3 major structural segments isn't a catastrophic structural failure for an insurance company.
Because it's not a failure. It is a calculated, highly strategic demolition designed to rebuild a much stronger base. I'll take back control here because the bottom line numbers absolutely prove out this strategy. Ask yourself, how did operating margins expand to 4.6%, which is up from 2.4% a year ago, while they were shrinking their membership? UnitedHealthcare's earnings from operations literally nearly doubled to $3.9 billion. Management clearly stated their 2026 approach prioritized margin recovery and product stability way over pure membership growth. They are intentionally sacrificing unprofitable membership to forge higher margins. They exited Louisiana Medicaid simply because it wasn't profitable. They tightened their pricing in Medicare Advantage, fully knowing they would lose price-sensitive seniors, but they retained the highly profitable ones. They are ruthlessly pruning the dead branches to save the tree. It's pricing discipline, and it's paying off immensely for shareholders in operating earnings.
Now, let's shift gears and transition to Section 2. This is the services side of the business, Optum. This is UNH's growth engine, the segment that perfectly diversifies them away from taking on pure insurance risk. And Optum delivered absolute strength this quarter. The entire segment pulled in $65.7 billion, driven by Optum Insight's AI tech, bringing in $5.4 billion, and Optum Rx's massive $38.3 billion in revenue. The overall operating margin for Optum expanded an impressive 160 basis points to hit 6.2%. Okay, but wait a second. Look at the volume. It is dropping across this entire ecosystem too. Optum Health revenue is actually down 5% to $23.5 billion after losing roughly 700,000 value-based care patients. And Rx scripts plummeted by nearly 30 million, down to 387 million, which is tied directly to the insurance membership declines we just analyzed. The margins are up, sure, but the volume is shrinking. When you look at the raw patient flow coming through the doors, the numbers are undeniably going in the wrong direction.
And there is one massive number in Optum Health I demand an explanation for. The filing outlines a $405 million net change in third-party loss contracts reserve. That is nearly $500 million set aside right now for anticipated future losses in structurally unprofitable value-based care contracts that they couldn't simply exit for 2026. How can you confidently call Optum Health a growth engine when they are actively taking massive charges for terrible contracts? Because it is absolutely necessary heavy lifting. This $405 million adjustment is them clearing out the bad structural contracts right now so they don't slowly bleed out capital later in the year. Management is just ripping off the Band-Aid. By reserving for these structurally unprofitable third-party relationships right now, they are ensuring that the 5.1% operating margin in Optum Health is a clean, highly reliable number going forward. It's a brilliantly defensive move that heavily fortifies the balance sheet against future shocks.
And they aren't just playing defense either. They are proactively restructuring the entire healthcare landscape. Just look at these structural reforms they're actively forging. They're implementing a gold card program designed to eliminate 30% of prior approvals by the end of 2026, which removes massive, costly friction for care providers. They've committed $1 billion to the UnitedHealth Foundation to advance community health. And in Optum Rx, they're leading an industry-wide shift to a highly transparent, modern pharmacy model, committing to 100% pass-through of manufacturer rebates by January 2028. These are long-term foundational investments that build immense regulatory stability for the entire company. While looking at the CEO's statement here, our results and outlook reflect the continuing progress in our work to simplify how we operate. That's Stephen Hemsley's quote. And that simplification is supposedly what is driving their confident decision to actually raise full-year 2026 adjusted EPS guidance to a range of $19.50 to $20. I have to admit, raising guidance while shrinking your core membership base takes a very steady hand at the wheel. If this simplification is real, if pruning the unprofitable members truly creates a much more resilient business, then that $20 per share target is going to look incredibly attractive to institutional buyers. But you have to wonder, if they cut too deep into the base, that simplification could easily turn into starvation down the road. That brings us right to our final verdict for the explainer today. Is UNH a steel-plated cornerstone for your portfolio right now? For me, the numbers are crystal clear. $11.1 billion in operating cash flow, massive margin expansion in both UnitedHealthcare and Optum, a lowered medical cost ratio of 86.7%, and raising EPS guidance to nearly $20 a share. This is a management team executing an absolute masterclass in margin recovery. They strategically sacrifice top-line vanity metrics like pure membership count to forge absolute bottom-line strength. And for me, I totally acknowledge the sheer financial power here, but I urge extreme caution on the structural volume. You can only prune a tree so much before it completely stops growing. Losing 525,000 members sequentially, dropping almost 1 million Medicare Advantage seniors, taking $500 million charges on bad Optum contracts, these are all incredibly serious stress points. The margins look beautiful today, absolutely, but if they lose their scale advantage long-term, that armor is going to dent. Excellent points on both sides of the ledger. So for everyone watching, you have the raw data and you have the structural blueprints. Is UnitedHealth Group's aggressive pursuit of profitability over growth the ultimate sign of strength, or is it the very first warning sign of fatigue? Let us know how you are building out your own portfolio.
Thanks for joining this explainer on Iron Financial, and we'll see you next time. Keep forging ahead.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.